Welcome to the masterclass on provisional tax. So what I'm going to do, just like I did with trusts in the section before this, is I'm just going to do a little bit of an outline for you guys just before we start. So as far as provisional tax is concerned, let's imagine we're dealing with an individual. An individual year starts on 1st to the 3rd, 2024. What's required to happen is that on 6 months after that, on 31st of August, 2024, you're supposed to make a first provisional tax payment. At year end, on 28th of Feb 2025, you're required to make a second provisional tax payment, and then you're required to make a third one 7 months after that, 30th of September 25. Now, let me just explain why it's on September, because you can't do first and third on the same date. So what they do is they give you 7 months for the third one. Okay. Let's just go through a couple more basics. If you're a company, guys, what happens is you need to make your best possible estimate. And what SARS will do is they can audit your estimate. So basically what that estimate will normally be will be actuals probably for 5 months, an estimate for 1 month, and your estimate should be close on that to actually work out your amount of your first provisional tax payment. Okay, or it could be an estimate for 7 months, and once you've got 12 months, you times it by half. There's got to be some sort of estimate for the first one if you're a company. If you're an individual, basically, you need to use your basic amount normally. Okay, for your second payment now, your second payment. Okay, now this is where there's no distinction between companies and individuals. I'm just going to actually just show you. For your second amount, you can pay anything you like. It doesn't matter what you pay. Okay, but understand there can be penalties. So often what happens is, instead of asking you how much, they say, what's the minimum amount to avoid penalties? So guys, it depends on whether you earn under R1,000,000 or you earn over R1,000,000 during the year. Okay. If it's under R1,000,000, what's actually going to end up happening is you, as long as you pay, okay, the lesser of 90% of actual or, okay, your basic amount, then there can't be any penalties. If it's over R1,000,000, there's not going to be any penalties as long as you pay 80% of actual tax. And that's what's going to happen with your second payment. Okay? And we'll come back to this. And with your third payment, okay, you are charged interest if you don't pay the balance on time. Okay, you're charged interest if you don't pay the balance on time. Okay, so we're just going to see how this works through a number of examples. So let's start. It says, assume Mr. Harry Pott, 80 years old, is required to register for provisional tax and is provided you with the following information. Salary earned 50,000 a month, and employees' taxes withheld at 18% due to a tax directive. Various investments were held in fixed property and shares, both local and foreign. He earns taxable income in excess of 150 from this portfolio. He paid 8,000 Rand a month in membership to a medical aid fund for himself and his wife. On 31 August, 13,000 expenses had not been reimbursed by medical aid. At 28 Feb, 20,000 had not been reimbursed. Now, let's just unpack why he has to be a provisional taxpayer. So for companies, every company has to be a provisional taxpayer. But for an individual, if you earn taxable income greater than 30,000, that's not remuneration, you need to register. Okay, this investment income of 150,000 euros is not remuneration. So what's going to happen? He's going to have to register for provisional tax. So that's why he's a provisional taxpayer. Okay, it says the following are the details of the previous years of assessment. This is all the information. This is basically used to calculate a basic amount. and we'll go through what the rules are for basic amounts now. So what happened, these are the dates of assessment, these are the amounts of the assessments, okay? And it says the 433,226 assessment includes a lump sum of 20, taxed in a fund, and a net capital gain of 10,000, not that was included in taxable income. It says the 785, this is actual. So this is actual, okay? And it says calculate the minimum amounts that need to be paid for the first, second, and third provisional tax payments. Okay. 4, in order to avoid penalties, indicate all dates that these amounts need to be paid by. So let's just unpack it. We need to do the first, second, and third provisional tax payments. What do we do if we're an individual? The first payment is on the basic amount. So that's why all of this information is given. So let's just unpack what basic amount means. So basic amount is basically your last assessment, okay, at least 14 days before payment is due. So let me just explain why we got this 14-day rule. People need SARS to tell them how much to pay. So on your RP6, which is the provisional tax return, they actually cut it off 14 days before, and they say the last assessment at this point in time was this amount, and this is what you need to pay. But you need to understand how this gets done. So it's your last assessment at least 14 days before it's due. Okay. And if it's more than 18 months ago, okay, add 8% simple interest per year. You got to add 8% simple interest per year. Okay. So let's just unpack this, guys. The first provisional tax payments on 31st of the 8th, 2024. Okay. Where would 18 months be before that? If it was 18 months before, we're interested in 28 February 2023. That would be 8 months before. So let's have a look. Let's go back and let's do this. 2022, 14 Feb 2023. So that one's fine. It's before 28 Feb 2023. Can you see? But that one's fine. Okay. The next assessment is done on 28 August 2024. And I want to ask you, is that more than 14 days before when you've got to pay? When do you have to pay? You have to pay on 31st of August 2024. Is that more than 14 days before? No. So what's going to be used as your basic amount for first provisional tax payment? That will be the basic amount for your first payment. And let me just explain. It says there's a little star there. And it says includes a lump sum of 20 and a taxable capital gain of 10. Now, when you work out your basic amount, what you need to do is you need to exclude lump sums and capital gains. So what basically your amount is actually 433,226 minus the 20 and the 10 for lump sums and capital gains. So it's 403,226. But the problem says if it's more than 18 months ago, you need to add 8% simple interest per year. Okay, so is this more than 18 months ago? Yes, it is. Because it was on 14 Feb 2023 and this payment's on 31st of August 2024, which basically means, and the 2022 year, guys, is 2 years behind, almost 3 years. It's 2.5 years behind where we're going here. So this is for the 2022 year of assessment. We are 3 years behind. Is that more than 18 months? Yes. So let's just have a look at how the solution will work. Can you see? It says use the 2022 tax year as the 2023 year of assessment was received within 14 days of the payment being due. Okay. Look what we've got. That's the assessment. But to work out the basic amount, remember we've got to take off the lump sum. We've got to take off the capital gain. That gives us 403. Because we are more than 18 months behind, what do we need to do? We need to add on simple interest at 8%. Simple interest at 8%. So what are we going to do, guys? We are going to say the following. We're going to say 403,226 times by 0.08, 8% simple interest, gives me interest of 32,258. And what are we going to end up with? 500,000 rands worth of basic amount. So your basic amount is the 403,226, but because we're 3 years behind, we've got to add 8% interest over 3 years. So that's where your basic amount is. And then look what happens, guys. We say tax per the tables. He's 80, so you get 3 rebates off. Less his tax credit, it's 364 Rand. It's for him and his wife. That was what was in the question. We take that off. And what is he allowed to do? He's allowed to say less 3 times 6A. Okay. He's allowed to take. So he's allowed to take his contributions plus his expenses, less 3 times 6A because he's over 65. And he'll get 33.3% as a medical aid tax credit, 6B. Total tax payable 51,378. That's for the year. He's only paying for half a year times by half. Gives you 25,569. And remember, what did the question say? It said that he earned 50,000 Rand a month. And he paid tax at 18% per month. And a fixed directive, which means he pays tax of 9,000 a month. He's already paid tax of 54. Therefore, he doesn't need to pay any more tax now. So guys, that's what happens. So what's the calculation? You need to use basic amount for your first one. So we use the basic amount. Remember, basic amount, you've got to take CGT and lump sums off. If it's more than 18 months behind, you need to add 8% simple interest for each year that you're behind. Tax per tables. Remember, it's only for half a year the payment, so you've got to times by half. Less your employee's tax that you've paid. Because remember, that's tax that's prepaid. He paid prepaid tax. And that means that there's a zero payment that you're going to have to do. Okay. Now, as far as the second payment is concerned, let's just go back. What happens with the second payment? It depends on whether we're under $1 million or over $1 million. So if we're under $1 million, it's the lesser of 90% of actual or basic amount. And in this question, remember, actual was 785,000. But the basic amount can change because we now got to look at 28 February as being the payment date. So let's just have a look at this. So looking at this table now. Yes? Looking at this table now. The basic amount is got to be at least 14 days before. So when are we paying? 28 February 25. Okay. This is at least 14 days before. So my new basic amount will be 700,000 Rand. That'll be the most recent one. It's only 1 year behind. So we don't need to add 8% simple interest because we only add 8% simple interest if it's more than 18 months behind. So this is our new basic amount. Okay, and actual is there, 785. There's your actual. So let's go and have a look in the solution on how we're going to do this. Basic amount, 700. What does the question thing say? Lesser of 90% of actual or basic amount, so lesser of the two. 90% of actuals, how much? 785 times by 90%, 706,500. So what are we going to use? You're going to use the lesser amount. Use the lesser amount. Okay, so what's the lesser amount? 700. So what do? We say tax per tables, that's on 700,000. Less your rebates, less your tax credit, less your medical aid calc. Notice here, now you can use the 20, not the 13, because now we've got the full year. Less employees tax paid. It's 12 months times 9,000. First provisional tax payment was 0. Second provisional tax payment is 13,216. And that's the minimum amount you need to pay to avoid a penalty. It's not the total tax you owe, because you've only paid tax on 700, whereas actually 785. And what is the third payment? The third payment is we got to catch up everything by 30 September 2025. Remember what's going to happen? Third payment by 30 September 2025 over there. And what are we going to do to get that up to date? We say actually 785. There's your tax per the tables, less all of your medical, less all of the taxes that you've paid. And that'll leave you with a catch-up payment of 33,150. So this third payment is merely to catch up all the taxes you haven't paid this year. It's like an actual tax calc. So third payment is like an actual tax calc. And that's what happens. So this is an example of what happens if someone earns less than $1 million. Okay. The next example I'm going to be doing with you is if someone earns more than $1 million. So here's task 2. It says you received the following from email from Ron Weasel. So let's have a look at what this says. It says, Dear Tax Practitioner, I hope you're well. It's Ron again. You may remember me from my previous correspondence about whether I needed to make a third provisional tax payment. I've always taken the bold step of managing my own tax affairs, but I'm feeling that I do not understand how much I need to pay for my second provisional tax payment. Clearly, I got it wrong with the amount of my second provisional tax payment. I base my second provisional tax payments on 1.5 million earnings. Now, guys, remember, what happens if you earn more than $1 million? If you earn more than $1 million, remember your second provisional tax payment to avoid penalties. To avoid penalties must be at least 80% of actual. So 80% of actual. That's what we're going to have to base it on. If there's tax per the tables was 514,519 and I paid 314,519, this is how much he did pay as the second provisional tax. He'd already paid his first payment of 200. So what did he think? 514,519 is what was owing. So he paid 314,519 because he'd already paid 200,000 the first time out. It says, my girlfriend told me that I should have taken my monthly medical aid contribution of 3,000 per month and 7.5 in medical expenses that were not paid by the medical aid into account. And silly me, I forgot to remove the rebate when I paid it. And task 2 instruction says, calculate the minimum amount that needed to be withheld for the second provisional tax payment for Ron Weasel in order to avoid penalties and interest, and send it to him. No discussion is necessary as you will meet with him to discuss the calculation you have made. So let's have a look at how we would do this. So we say actual is 1.5 million. To avoid a penalty, I need to pay at least 80%. So 80% of 1.5 million is 1.2. Tax per table, 391,519. Can take my rebates off. Okay, guys, sorry, this should actually say 4 times 6A. Apologies. And there's your medical calculation itself, which gives you 369,916. Remember, it's 4 times here because he's not over 65. Less his first provisional tax payment means that's what his second provisional tax payment will be based on. So just remember, if it's a second payment that you're trying to actually calculate and you've earned more than R1,000,000, it's 80% of actual that you need to pay in order to avoid a penalty. And that's as simple as it is as to how to actually calculate this. No discussion of provisional tax would be complete if I didn't show you some of the interest and penalties. So that's what task 3 is for. And this is to show you what happens if you don't pay on time, if you pay less than the minimum provisional payment. So that's what this example is doing. It says in the 2024 year of assessment, Hermione Grander earned 412,769 from a teaching job in investment portfolio. She was assessed on 6 July 2024. She registered as a provisional taxpayer. She earned 20,000 Rand a month for taking care of her money and also has an investment portfolio. She made a first provisional tax payment of 8,675 on 28 August and a second provisional tax payment of 40,000 on 5 March 2025. Now, this is the first thing I want to unpack. If you do not pay on time, there is a penalty. So let's just unpack this penalty. There's a 10% penalty for late payment. She paid on 5th of March. She was supposed to pay by 28 Feb. So there's a 40,000 Rand payment. 10% penalty means that there's a penalty of 4,000. And because you haven't paid on time, there's also interest that gets charged. So interest levied will be 40,000. That's what you paid late, plus the 4,000 Rand penalty. And guys, this is the official rate of interest, 11.25. What I did was I did show you a link, and that you can go get the tables of interest rates if you want to do this in practice. But it's 11.25. The 11.25 is discussed in the question itself. There it is. There's the 11.25 over there. Right? And what are you going to do? You're going to pay interest of 40,000 plus 4,000 times 11.25. And guys, you paid it on the 5th of March, so there's 4 days that you were late. 4 over 365, there's 54 and 25 interest. So just want to show you how the penalty gets done. Just want to show you how interest gets done. I've now got the thing called an underestimate penalty. We'll just discuss that now and unpack this. So it says she has now completed a tax return and earned a taxable income of 478,652. She's not a member of a medical aid, has not kept any medical aid information for the year. So let's just unpack it. She's now got taxable income of 478. Remember what happens. We can either use 90% of actual for your minimum payment, or we can use basic amount. How much is your basic amount? That's last year, 412,769. Is it more than 14 days before? Yes, she was assessed on 6 July 2024. What's 90% of actual? 478,652 times by 90%. So look at the solution. Basic amount, 412,769. 90% of actual, 478,652 times 90%. What are we going to use? The minimum payment should have been based on 412,769. Tax per tables, 90. Primary rebate. Guys, what's going to happen here? Provisional tax. Sorry, that shouldn't be there. 8675. Now notice, because we didn't pay it on time, it does not go into the underestimate penalty calculation. So 0 had been paid by 28th of February. Okay, 2025. which means how much you're still owing, 64,555. And what is the underestimate penalty if we don't pay the minimum amount? It's 20%, which means that there's a penalty of 12,911. Now, the way that SARS works is it says that because you've already been penalized for paying this late with the 4,000, whatever you're penalized for paying it late, you don't get fined twice for it. So what you are able to do is you're able to take the late payment penalty off the underestimate penalty, the one that you put the two lower amounts in, and you will just need to pay the net difference. So the sum total of all of your penalties will be 12,911, 4,000 for late payments, 8,911 for the underestimate penalty. So all I wanted to do with this was to just give you a basic example to show you how the penalties would work if you do not make your minimum tax payment.